Hello and welcome back to the Deep Dive. Before we jump in, just a quick note. This material is created by EasyPathUni by coordinations with Yazan Ibrahim. And joining me today, well, we have an expert whose background is just perfect for this. We're talking extensive professional experience as a head of internal audit for financial departments, plus certifications like CISA, CFE, GRCP, GBRCA, IPPA, FMVA, CBCA, and BETA. So, a deep well of practical and theoretical knowledge in audit, risk management, financial analysis, all backed by solid education. Exactly the insight we need, our mission for you today, to cut through the complexity, the jargon, and really pull out the key insights from cost accounting, principles, and strategic applications. We're diving into the financial fabric of how businesses actually work.
Yeah, it's fascinating stuff because cost accounting, it isn't just, crunching numbers in a back room. It's really about understanding the engine of the business, the operational heartbeat. This deep dive should help you see not just what things cost, but more importantly, why those costs matter for strategic success.
Absolutely. So if you've ever wondered, say, how companies really set their prices, or how they figure out exactly where they might be losing money, maybe bleeding cash somewhere, well, you're definitely in the right place. Get ready to understand how businesses track, analyze, and crucially, manage costs at every single stage. It's all about enabling smarter decisions, getting a handle on expenses, and ultimately boosting that bottom line. Let's dive deep. The deep dive, cost accounting revealed. Okay, so first things first, when a company needs to understand its real costs, beyond just the surface level stuff or external reports, what exactly are we talking about? What is cost accounting at its core?
Well, think of cost accounting as the business's internal navigation system, traditional financial accounting. That's mostly outward facing. For investors, lenders, regulators, giving that broad overview. Cost accounting, though, looks intensely inward. It gives management really granular, detailed data, costs for making a specific product, delivering a particular service. And this internal focus is, well, it's critical for making those big strategic calls. Things like setting competitive prices, finding ways to control and maybe reduce certain costs, making sure resources are used efficiently, and yeah, ultimately, improving profitability. It lets you slice and dice costs by product line, by department, even down to specific activities.
That distinction really clicks. So financial accounting is like the official report card shown to the public, but cost accounting, that's the internal study guide, the playbook for improving the grades. Makes sense. Now, once a business knows what a cost is in this context, how do they start sorting them out? I mean, surely not all costs behave the same way.
That's exactly right. And how you classify costs, it's foundational. Really, step one. Our source material points to three main ways. First up, classification by behavior. This looks at whether a cost changes when production volume changes. Think variable costs, like raw materials, more units, more cost. Or fixed costs, like factory rent that stays the same regardless of how much you produce, within limits, of course. And then there are mixed costs, part fixed, part variable. Understanding this behavior is key for, say, forecasting and setting budgets.
Okay, behavior makes sense. What's next?
Second is by function. Is this cost related directly to making the product? That's a production cost, like direct labor. Or is it about selling it? That's marketing. Or running the general office, administrative costs. This is really vital for managing departmental budgets and understanding where the money's going functionally.
Right. And the third one you mentioned, traceability, direct versus indirect costs. This feels like where managers can really start to see what's driving the cost of a specific product, doesn't it?
Precisely. That's a huge one. Direct costs are the ones you can easily, clearly trace right back to a specific product or service. Think about the wood used in one specific custom-made table, or the wages of the craftsperson who only worked on that table. You can point and say, that cost, it belongs to this specific item, unequivocal. But then you've got indirect costs, often called overhead or common costs. These are shared across lots of products or services, like the electricity for the whole factory, or the factory supervisor's salary, or the depreciation on machinery used for multiple product lines. You can't just point and say, that bit of electricity was for product A. And that's the challenge, right? How do you fairly allocate those shared costs to get an accurate picture of each product's true cost? That allocation piece is key.
It really is like having X-ray vision for the finances, isn't it? This whole classification system lets you peer inside and see how all these different pieces truly add up to the total cost picture and eventually the profit on each item. It feels like the essential first step before you can optimize anything.
Absolutely. Once you've got a grip on classifying costs, the next logical step is figuring out how businesses actually accumulate those costs and then allocate the indirect ones. And the method they choose really depends heavily on what they're producing. Is it unique items or mass-produced goods? The source highlights two main methods here: job costing and process costing.
Okay, job costing. That name implies it's for specific jobs, like unique orders. Can you give an example?
Exactly. Think custom work. A construction company building a specific bridge. A consulting firm doing a unique project for a client. A print shop doing a custom batch of brochures. Each of these is a distinct job. With job costing, you meticulously track all the costs, the direct materials, the direct labor, and an allocated portion of overhead for that specific job. The beauty is, the precise profitability of that individual project or order. Super important when every order is different.
Right, makes sense for custom stuff. So how does process costing differ then?
Process costing is kind of the opposite end of the spectrum. It's for industries churning out large volumes of identical or very similar products. Think oil refineries, chemical manufacturers, food processing plants making tons of cereal, maybe breweries making beer. Here, the products flow through a series of processes or departments. So costs are accumulated by process or by department for a period of time. Then you calculate an average cost per unit coming out of that process. Since every unit is basically the same, an average cost worked perfectly well.
Okay, so job costing for unique items, process costing for mass production. But I know businesses can get pretty complex. Sometimes traditional methods, especially with those tricky indirect costs, might not give the full picture. I've heard about activity-based costing, or ABC. Is that designed to get even more accurate, especially with overhead?
Yes, absolutely. ABC is a more refined approach, particularly powerful in complex environments. See, traditional methods often allocate overhead using simple bases, maybe direct labor hours or machine hours. It's kind of broad brush. ABC says, hold on, overhead costs aren't just driven by volume, they're driven by specific activities. So ABC first identifies the key activities that consume resources, things like setting up machines for a production run, processing purchase orders, performing quality inspections, handling customer service calls. Then it figures out the cost of each activity. And finally, it allocates those activity costs to products based on how much each product actually uses that activity.
Okay, hang on. Can you give a quick example? How might ABC show a different cost than, say, traditional costing?
Sure. Let's imagine a company makes two products. Product A is simple, high volume, runs smoothly. Product B is complex, low volume, needs lots of machine setups, frequent quality checks, and maybe more customer support. Traditional costing might just spread the setup costs and support costs evenly based on, say, labor hours. Product B might look okay, maybe even profitable, but ABC would say, wait a minute, product B costs way more setups. It uses most of the quality inspection time. It drives those support calls. So ABC assigns those specific activity costs much more heavily to product B. Suddenly, you might see that product B is actually losing money hand over fist unless its price is raised significantly, or maybe the process needs a serious rethink. ABC uncovers those hidden cost drivers.
Wow, okay. That really highlights the difference, getting the true cost. Now, once we have a better handle on classifying and accumulating costs, managers need tools to predict the future almost. How do changes in sales volume affect profit? That seems crucial. And that brings us to cost volume profit analysis, or CVP, right?
Exactly. CVP analysis is a really powerful tool for exactly that, understanding the relationship between your costs, how much you sell, volume, and your resulting profit. It's predictive. It really boils down to a few key concepts. First, probably the most famous one, is the break-even point. That's the level of sales in units or dollars where your total revenue perfectly matches your total costs, both fixed and variable. So zero profit, but also zero loss. It's that minimum target you absolutely have to hit just to cover your costs.
The survival point, essentially. What else is key in CVP?
Next is the contribution margin. This is super important. It's simply your sales revenue minus all your variable costs. What's left over the contribution margin is the amount that contributes towards covering your fixed costs. And once those fixed costs are covered, every additional dollar of contribution margin becomes pure profit. It tells you how much each sale adds to covering fixed costs and generating profit. Vital for pricing and deciding which products to push.
Okay, break even and contribution margin. And you mentioned a third, the margin of safety. That sounds reassuring.
It is. The margin of safety is basically your cushion. It tells you how much your current or projected sales can drop before you hit that break-even point and start losing money. It's usually expressed as a percentage or a dollar amount. A bigger margin of safety means less risk. And within CVP, the source also points to sensitivity analysis. This is where you run what-if scenarios. What happens to my break-even point, or my profit if, say, my material costs go up by 5%, or if I lower my selling price by 10% to boost volume, or if fixed costs increase. It's incredibly useful for assessing risk and making strategic decisions under uncertainty.
It really sounds like having a financial dashboard for navigating decisions, knowing those levers cost, volume, price, and how they impact the bottom line. That's powerful stuff for planning.
Moving from planning to control, we get to variance analysis. This is where the plan meets reality. Businesses compare their actual results, actual costs incurred, actual revenue earned against what they budgeted or set as a standard. And the key here isn't just finding a difference, it's understanding why there's a difference. It's not about blame, it's about learning and improving. We talk about favorable variances, that's good news, like actual costs being lower than budgeted or revenue being higher. And unfavorable variances, that's the signal to investigate, like costs being higher than expected or revenue falling short.
Right, so it's not just a single number like, we were $10,000 over budget. It breaks it down further, doesn't it? What are the typical kinds of variances managers look at to get those specific insights?
Yeah, it definitely drills down. You get much more specific information. For instance, you'll often see a price variance. For materials, this tells you if you actually paid more or less per unit than the standard price you'd planned for. Maybe a supplier gave you a discount, or maybe prices jumped unexpectedly. Same idea applies to labor rates. Then there's the quantity variance, sometimes called efficiency variance. For materials, did you use more or less raw material than the standard amount allowed for the actual number of units you produced? Maybe there was unexpected spoilage, or perhaps a process improvement reduced waste. For labor, did workers take more or fewer hours than standard? And finally, you often look at volume variance, especially related to overhead. This looks at the impact of producing a different quantity than you originally budgeted, which affects how fixed overhead costs get absorbed per unit.
Okay, so digging into those specific variances gives real clues. A bad price variance might point to procurement issues. A bad efficiency variance might suggest problems on the production line, maybe needing better training or machine maintenance.
Exactly. The ultimate goal is always root cause analysis. Why do we pay more? Why do we use more material? You break down these variances to find the underlying drivers. And once you understand the why, then you can take effective corrective action. It creates this really valuable feedback loop for continuous improvement, pushing the whole operation to become more efficient.
So pulling it all together, what's the big picture here? The strategic role. It's clear cost accounting isn't just some back office function. It sounds like it's right at the heart of management decision making.
Oh, absolutely. It plays a vital strategic role. First off, budgeting and planning. You can't set realistic financial targets or allocate resources effectively without solid cost data. That's the foundation. And then variance analysis provides that crucial feedback to refine budgets and operational plans as you go. It's dynamic. Secondly, it's indispensable for pricing and profitability analysis. You need accurate cost information to set prices that are both competitive in the market and actually generate profit. It helps identify which products or services are your winners and which ones might be underperforming or even losing money, maybe needing changes or even phasing out.
And I guess that ties directly into measuring how well different parts of the business are doing, performance measurement.
Precisely. Cost accounting allows for meaningful benchmarking. How do our costs compare to industry averages? How do they compare to our own performance last year? It can even support incentive programs and accountability by linking specific costs back to the departments or managers who are responsible for controlling them. It really fosters a culture of cost awareness and drives efficiency throughout the organization. It tells you if you're truly effective. Now, just to give listeners a peek at what lies beyond these fundamentals, are there more advanced concepts that show how this field keeps evolving? Yeah, the source briefly touches on a few, which is great. It shows the depth. There's standard costing, which involves setting predetermined cost standards for materials, labor, and overhead. Then you analyze variances against these detailed standards. It's a powerful control tool. Then there's life cycle costing. This is really interesting. It looks at all the costs associated with a product over its entire life, right from initial R&D and design through production, marketing, support, and even final disposal. Supports much longer-term, more realistic decisions. And another big one is target costing. This flips the usual approach. You start with the price the market will bear, subtract your desired profit margin, and that gives you the maximum allowable cost, the target cost. Then the challenge is to design the product and processes to meet that target. It actively drives cost reduction right from the design phase.
Those definitely show it's not a static field. Cost accounting is constantly finding new ways to provide insights for better management and strategy. And that, I think, brings our deep dive into cost accounting to a close. It's really clear. It's so much more than, just keeping records in a dusty ledger somewhere. It's a truly active, dynamic management tool. It empowers organizations to really get under the hood, understand their cost structures, control expenses effectively, and drive smart, strategic decisions. We certainly hope you feel much more clued in on this vital subject now.
Yeah, and if you connect all these pieces, understanding cost classification, the different accumulation methods like job and process costing, using tools like CVP analysis, and learning from variance analysis, these are the fundamental building blocks. Mastering them allows managers to genuinely optimize operations, boost profitability, and really maintain that competitive edge. It fundamentally changes how a business thinks about competing and succeeding.
So, for you, our listener, here's a final thought to perhaps chew on. How might this deeper understanding of cost accounting change your perspective on the everyday things you buy and use? Knowing all the layers of strategic decisions, the intense cost analysis that likely went into figuring out the price and the production of that product or service, does it make you value it differently? Something to mull over.
Thank you for joining us on this deep dive.
We really hope you enjoyed the journey, and we'll catch you on the next one.